Hi, and welcome to the September edition of the Muni CreditCast, BAM Mutual's monthly podcast that talks about questions investors should ask about U.S. municipal bond investments and seeks to explain why we say,
if you've seen one municipal bond, you've seen one municipal bond.
Hi, I'm Mike Stanton. That's my partner on this podcast, Suzanne Finnegan, our co-host, the Chief Credit Officer for BAM Mutual. Suzanne, thanks for taking some time today.
Thanks, Mike. Happy to be here.
You know, this is going to be an interesting podcast. We're going to be talking about the public power industry. And frankly, in the municipal bond market, we don't talk about growth all that often. But I think one of the things we're going to talk about here is that there's an expectation of a growing volume of bonds because the electric power industry is changing so much. But before we get into that, and we've got some great guests, John Miller, our senior advisor for public power here at BAM, and Jill Schmidt, who's our lead underwriter in the sector. Before we dive into that a little deeper, I'd like to kind of talk to you at the higher level. You know, from a homeowner's perspective, when they talk about utility bills, they talk about water, sewer, and power all in one big bucket. But as a bond analyst, do you see them the same way, or are they really more distinct?
No, I think they are more distinct. We do look at the aggregate cost of all the essential utilities to a homeowner when we're evaluating the credit quality of these systems. But we do look at them individually. And I think there are a couple of components that differentiate public power from the other water and sewer types of utilities. That is that there's more market risk typically associated with some of the public power credits. You have to purchase fuel, whatever that type of fuel may be, and you have to you're subject to a substantially higher amount of regulations than the water and sewer utilities typically are. So those factors combine to make it a little bit more challenging of a credit sector.
So, you know, the label public power covers a real diverse range of issuers, and some of them have very different missions. Can you give us a sense of what some of those are?
Sure. So the kind of baseline public power entity is really just to generate a distribution system. So that entity may also own some generation, or they may just purchase power from another provider. And that can be from another public power agency or from an investor-owned utility. Then you have longer range transmission utilities, which typically don't have any generating, but they just move power from one place to another and then connect to retail distribution systems. And then finally, you can have a utility that just is standalone generation. They don't transmit it and they don't deliver it to retail customers.
And presumably you also have some, you know, hybrids of all of those different
That's right.
models.
You do have systems that incorporate all of that together.
So, you know, talking about a hierarchy in the marketplace, you know, is any one of those types of debt clearly more creditworthy than others? You know, is every distribution system safer than a generation system, or do you have to get down and look at the individual issuer?
No, you really have to get down and look at the individual credits. Generally speaking, distribution would be safer than generation, but what you find is that the generating utilities tend to be larger, very sophisticated entities, and so they manage their risks very well.
That's a very interesting point because we're starting to hear it from other people in the marketplace that they are paying more attention to management as a credit factor across all sectors, not just public power, but particularly as there's some generational transfer going over in leadership in across the municipal market. That management question is being asked more often, so it's interesting that it comes up here as well.
Yes. Mm-hmm.
So let's pause for a second. We'll bring in John and Jill, broaden the discussion, and talk a little bit more some specific credits. Thanks. Okay, and we're back to talk about public power here on the Muni CreditCast. As we said, we're joined by John Miller, Senior Advisor to BAM Mutual, focusing on public power. Jill Schmidt, our head underwriter in the sector, is, of course, my partner and co-host, Suzanne Finnegan, our Chief Credit Officer. Thanks, everybody, for joining us today. This is the largest crowd we've ever had for a Muni CreditCast taping. So, so far, so good. We'll see if we can keep it up. John, you've been focused on this market really for decades. You've seen a lot of trends in the overall market as well as at the issuer level. So let's talk about the history for a minute, if that's right, before we look to the future. The public power sector used to be a much bigger piece of the municipal bond market. I know when I got into this business a little more than 25 years ago, there were some massive issuers of muni bonds all in the public power sector. That debt has been allowed to amortize. It hasn't been replaced at the same rate because of some bigger market changes. Can you give us some insight? What changed there?
Well, it's a long history in public power, and I think, as everyone knows, this is a popular service delivery model and delivering electricity, but also for its members, it's something of a calling. Its hallmarks are local control, independent rate setting, ownership of assets, and the watchword really in the business is about customer service. There's a strong belief among many of these smaller systems that local control, local ownership leads to lower rates. In many cases, that's proven to be true, but the real competitive advantage and the source of the low rates has always been in its financing. This is a sector that's have access to tax exemption. It has many long-lived assets that were financed with long-term tax-exempt debt, and it led to a lower cost structure that persisted for many, many years in this industry. About 10 years ago, we saw a confluence of a number of trends that really changed the trajectory of that level of issuance. And many are environmental in nature, but they all kind of came together to put a real pressure and change on the resource mix that public power agencies were designing. You saw an enormous pressure to close coal plants. At the same time, there was a reaction to building additional nuclear, and there was a sense that gas could only be a transitional fuel and was really not much cleaner than coal. And so you have a situation where really all three of the existing primary forms of generation were under pressure and not very popular. And there was a point where I think 2015 was the last major coal plant that was constructed in this country. So a lot of the resource that people had relied on and had financed with tax-exempt bonds was really no longer available. What happened at the same time, though, was this enormous change in technology. And suddenly you saw wind projects and solar projects becoming popular. And for really environmental reasons, there was a slow change, somewhat out of necessity, but somewhat out of a desire for cleaner assets to move into both solar and to wind. And then a funny thing happened. Technology change drove the costs down dramatically. When these things were first proposed, they were maybe double the cost of a natural gas plant that was being installed. Now there was an article literally in the New York Times last week that's saying that solar was going to be too cheap to meter. And that's not quite true yet, but you can see that there's been just enormous change in terms of the technology and its cost. And that's led to a period of about 10 years of enormous uncertainty on the part of many public power agencies on what to build, what they could build, what would be most economic. And it led to one of our clients famously saying to me one day, "I'm no longer willing to take 30-year risk. I don't know what's going to happen to technology. I don't know what's going to happen to prices." And this understanding of their assets that led to use of 30-year long-term tax-exempt bonds had eroded. Now, a funny thing happened. The federal government, seeing these trends, adopted a wide-ranging series of tax-advantaged credits and other forms of tax, savings to developers of both solar and wind. Now, intriguingly, as a tax-exempt entity, public power agencies were not able to take advantage of any of those tax credits. And so it created an environment where developers could bring financing that was tax advantaged, that actually was in many cases lower in cost than the tax exemption for bond financed assets that had been in place for many, many years. I remember at one point I was hired by JEA to create this really novel new financing structure that we did, and we were convinced that it would work. It was an off-balance sheet, tax-exempt prepay of electricity to finance a very large solar installation in Jacksonville. We put it through a competitive process, and one of the French developers beat our price because they had access to subsidized, national funding. So you had a combination of companies trying to get into this business that had subsidized finance as part of their business strategy to expand, combined with federal tax advantages that gave private developers, in many cases, an equal cost to what tax-exempt financing could have done on a traditional ownership model. And so over a long period of time, you went from $20 billion of issuance down to 2018, where there was about $5 billion. And it's kind of lingered at that level. But the last 2 years, we've seen a significant uptick. And I believe you're going to ask another question in a moment about, why we see growth in this sector again.
You're pulling back the curtain and letting the listeners know that we might have actually planned this ahead of time. But I really do like the place you started there. This idea that the culture is anchored in customer service, and that the public sector leadership, responding to that and following that, changed the way they work and changed the scope of their entities because it was the right way to deliver the customer service. Jill, let's get you into the conversation because I want to give people a roadmap a little bit. About 35% of the country's electricity is provided by public power utilities. Are they everywhere? Or are they more concentrated in certain regions? Where do you find that?
About 2,000 municipal utilities located across 49 states, serving about 25 million end-use customers in the U.S. The only state that doesn't have at least one municipal electric system is Hawaii. And they're really dispersed nationally, but some states definitely have a greater presence of these public electric utilities, with Nebraska, Iowa, Minnesota, Kansas, and Ohio being the 5 largest. On a combined basis, in those states, there are over 600 utilities serving 2.3 million customers. And then you have states that have very little presence. Rhode Island, Montana, West Virginia, New Hampshire, Maryland are kind of the 5 lowest. On a combined basis, they have just 14 utilities serving only about 57,000 customers. So, and then you have, within this dispersion, other nuances. You have some very large cities that are served by municipal systems. Los Angeles Department of Water and Power is the largest, serving just over 1.5 million customers, followed by CPS Energy at 918,000 customers, and Sacramento Municipal Utility Department serving about 650,000 customers. And then on the opposite of these big systems, you have some smaller rural systems. And a good example of these being served are the creation of 2 big federal power marketing administrations, including Bonneville Power Administration that serves about 3 million rural customers in Montana, California, Nevada, Utah, and Wyoming. And you also had Tennessee Valley Authority, or TVA, that serves around 10 million rural customers across the Southeast. So although public power utilities only serve about 35% of the country's electricity, it's clear that these entities have a strong presence across the nation.
Yeah, and one of the things I think is really interesting is, in retrospect, the electrification of the country, in the big picture, happened in a pretty remarkably short period of time for the scale and importance of that new technology. On the other hand, if you look back at the history, I'm sure by the early years of the New Deal, when the Rural Electrification Act was a major part of that thing, there were still large parts of the country left out of electrification, and that must have been painful, right? You're talking about missing out on the new area. So it's interesting how public power in a lot lot of places was the last piece of the puzzle and was an important part of keeping the entire country kind of unified in the introduction of that new technology. And so then today you fast forward and you see growth since then has been different in different places. So you have some massive public power utilities in cities that have grown very quickly, like San Antonio. You have some very small ones and that have remained rural and remained agricultural. So it's a very diverse universe. So John, let's go ahead and look ahead as we were talking about public power bond sales. You mentioned they're up in 2023, they're up in 2024. There are indications there may be more growth ahead. What are some of the things driving that?
So sometimes you get answers in obvious places. There was an announcement this morning from Constellation Energy that they're reopening 3 Mile Island number 1. This is the nuclear plant, not that was part of the accident, but the one that was closed down about 5 years ago because the costs were not competitive with gas. They are opening it. They're targeting a date in 2028, and the customer, notably, will be Microsoft, who is buying 100% of the power for its AI business. And you can just think of where some of the growth is coming from, and that's a really good example.
And I'm sure in that particular case, you have a situation where Microsoft wants to put a stake in the ground saying they're buying zero carbon energy. That's why the nuclear is attractive.
Many of the large tech firms have very aggressive environmental policies, some of which are demanding 100% renewable or green power. And you've seen them very, very active in long-term contracts for wind and solar. This is the first one in nuclear. But it's really a particularly good example of the combination of increased demand from technology, having all this power go to AI, the private, really, if you will, contracting for power and building more nuclear, which, without that likely is not going to happen because it's been proven to be so expensive. And combined with these green mandates that people have. But if you put all that kind of in, one box as an example, I think growth comes from a number of places. There is continued population growth in this country. There's very good economic activity. The data centers are exploding all over the country. This is just one example. And you've got the ever popular electric cars, which are creating, new sources of demands. Data centers are an interesting concept. It's sort of easy to say, but unless you've actually seen one, the scale is unimaginable. The first one I ever visited was in Oklahoma. I was on a tour on a deal we were doing with GRDA, and we were in their helicopter with Moody's, flying around looking at all of their different generating sites. And we happened to fly over the new Google data center. This was one of the early ones, which was big at the time, but is not so big today. It was roughly the size of 4 football fields, and completely ringing the building were dozens of these little modules, which we learned were gigantic air conditioners. And that's where the energy is used. I mean, it takes massive amounts of electricity to run the refrigeration to keep the data centers cool enough so that the computer servers, will operate. That facility, which was maybe a couple 100,000 square feet, has been surpassed, where a large one now is considered 1 million square feet, and the largest one in the world is actually in China. It's 13.7 million square feet on one data farm. And so think of the scale and the amount of power. Another thing that's happening is that, there's been a lot of natural disasters, over the past few years that have affected many parts of, the industry. And you have a new sense of urgency on reliability and hardening of the systems and undergrounding transmission and really making these things more reliable over a long period of time. And so you have a situation where there's increasing demand, increasing need to improve the reliability of the systems. And lastly, I would say, I think as a incremental resource on its own, renewables may have run its course. And so there is a increasing plan for additional gas plants, probably not coal, but you need to have the reliability of supply, to be able to sort of, firm up, what is obviously the incremental load of renewables. And so you've got combinations of kind of catching up on the asset mix that people have, natural growing demand, and an increased need for reliability. And so there's a lot of sources driving this. And intriguingly, good old tax-exempt long-term bonds to finance these assets seems to be, the financing tool of choice, which is what I think we're fundamentally seeing that's driving the increase in volume back to more historic levels.
And one thing I know that changed, you mentioned earlier that the investment tax credits for a long time were only accessible to corporate and corporate tax buyers. That did change in the IRA. The Inflation Reduction Act
Right.
had language allowing public power utilities to get a refundable tax credit even if they're not paying taxes. I think that's a little slow to roll out. We were just at a conference earlier this week where people said, when you have something that new, you're going to wait until the federal regulations around that are really set in stone before you try to
Right.
build a heavy investment, a long-term investment that relies on that cash flow. But something certainly that to watch in the public power sector. Question for you, John, and/or Suzanne. What are the uncertainties? What are the questions you still want to ask when a public power transaction comes to the table now?
Well, I think to John's point, understanding their long-term goals and plans. There have been so many changes in the industry in terms of the cost associated with different types of power generation, and the resources available. As you know, I spend some time in Wyoming, and a lot of the coal mines here are closing. And so that poses questions and risks, I think, for utilities that are still using coal-based plants. I'll turn it over to John to add his thoughts.
Well, I think there's two parts to it. One is sort of the fundamental nature of their business, in terms of, demand, the quality of their assets, the service quality, and just their ability to manage their system. The other one that in many ways used to be, I think, more fearful or created more fear than it does now is their rates and their relative competitiveness. Many parts of the country still have, potential, competition in electricity, but nevertheless, all rates are local, and it kind of depends upon, where you are and who the competitors are, what kind of rates are surround you. But, you look really at the economics of their system and how much it costs. And it's in some places it's a question of affordability. Sometimes it's a question of relative economics. And you still look at that. At the end of the day, what are their rates, and are they under pressure, to increase them or in a competitive context? Because at the end of the day, the quality of the service is in many views of many ratepayers and customers, what they pay for it. And
All
so,
rates are local might be a new tagline for this podcast. You never know where you're going to discover the next one. Jill, I want to get you back in the conversation. In an uncertain market, it's not surprising that you would see more interest from investors in insurance on transactions, and public power is no exception. Earlier this month, BAM insured $94 million of a larger revenue bond issue for the Municipal Electric Authority of Georgia. As John has noted a couple of times today, this is a industry of acronyms. And so they go by MEAG. MEAG's an interesting public power credit to talk about in this context because they're kind of at the intersection of a lot of these trends. They have some nuclear exposure. They've invested heavily in non-carbon generating assets in the last couple of years. There are also multiple credits under the MEAG name. So can you tell us a little bit more about this most recent issue and how you as the underwriter evaluated the debt before BAM made the decision to insure it?
Sure, Mike. So just talk a little bit about MEAG. So MEAG was created in the mid-70s to provide reliable and economical wholesale power or wholesale supply of electricity to municipal electric distribution systems across the state of Georgia. So MEAG acquires and constructs generating facilities to serve this purpose, and it serves 48 member cities and one member county across the state, or a population of about 653,000, to kind of put it in perspective of how big it is. We really like this MEAG credit, all the MEAG credits, I say. And I say credits because MEAG has multiple series of debt respective to each different project. And they are distinctly separate credits with separate contracts and separate member mixes. The bonds that we insured earlier this month were in association with MEAG's Project One, which originally financed the ownership interests in various nuclear and coal generating facilities. All 49 members participate in Project One, and MEAG has a separate contract with each member spanning through the life of the bonds. Under the contracts, the members are allocated a percentage of power from the project, and in return, the members are obligated to pay the same allocated percentage of expenditures and debt service on the project from their each respective electric systems. These contracts are what we call take or pay contracts, or more commonly referred to as hell or high water contracts. So it essentially means that the members have to make their payments under the contracts regardless whether the projects are operational or not. So the members are obligated to make these payments, from their electric as an expense of their electric system prior to any of their own outstanding debt. And these contracts for this particular project include a step-up mechanism where if one member were to default, then everybody else would have to step up to 150% of their original allocation to help cover those lost revenues. And making these MEAG contracts even stronger than we typically see in this sector is the fact that each member also pledges its unlimited tax general obligation pledge as a backup. So if a member's electric revenues are insufficient to make their payments, the member would be obligated to levy property tax in an amount sufficient to make these payments. And further, as icing on the cake in Georgia, all bonds and securities have to be court validated, with the judgment of validation being forever conclusive against the parties to the transaction. So that's something we really like across all Georgia contract transactions. So we really like the contract structure of these bonds, but also very important is the analysis of the members. Because you have to make sure that their credit quality is sufficient that they can make these payments under the contracts. So there are 49 members here. We did do a deep dive on each participant that was, over 5% of the project allocation. And in this particular instance for this project, there were only 5 that met that criteria. And each of these participants have a really strong credit profile. Each has an outstanding rating on their general obligation debt that was AA3 or higher. They have stable customer bases, generally affordable electric rates, net revenues sufficient to cover all their obligations, and healthy liquidity levels kind of across the board. So in summary, while we do look at the underlying projects, of course, that are being financed with the bonds or that have been financed, our approval on the MEAG 1 project bonds mainly hinged on the very strong contract structure with the double barrel revenue GO pledge, the court validation of the security, and the solid participant mix.
So Suzanne, I'm not sure I'm going to get to a question as I wrap this up, but one thing I'll just say from a personal perspective, listening to Jill go through that, I think that's a really good illustration of some of the brilliance of what you built into the underwriting standards here at BAM as we launched the company over the last decade, and you as Chief Credit Officer, because it shows the need to balance the legal analysis and really understand the contracts, really understand the documents, as well as the economic analysis, understand the underlying strength of the communities. Do they have the wherewithal to generate the revenues that are going to pass through? And BAM obviously has the time and the scale to invest and understand that across communities. Maybe the question is, as we wrap it up, so MEAG is just one of many public power utilities. How common is that structure? Or how are parts of it present in other places? Do people have a completely different model in other places? How often do you have to do that full spectrum analysis?
Well, Jill can testify that she has to do the full spectrum analysis fairly frequently. We do see, and when we have a very, very strong preference for transactions where the contracts are, as Jill described, take or pay, or hell or high water. We don't want to be reliant on the ability of a single utility power plant to be operational at all times. So we look for that take or pay common thread, and that is in most municipal contracts. So that is a very common feature and very, very important to the transaction. Georgia has the added benefit of the tax the taxing ability behind it, which we don't see in many other places. And Jill's point about the icing on the cake, the judicial validation, we don't see that in a lot of other places either. We do see it in Florida, but the Georgia judicial validation is a very, very strong.
Well, thanks. Anybody have anything to chime in? We've covered a lot of ground here, and I think we'll have to, as we keep moving forward with the Muni CreditCast, we'll put a pin in the calendar in 12 or 18 months and revisit this and see how the volume played out, see what kind of additional growth happened, and test our assumptions. But thank you all for your time today. Thanks to the listeners for listening. The Muni CreditCast is presented by BAM Mutual. We're here everywhere you get your podcasts every month. We would love to start a mailbag section of the podcast. So if you have any questions, any follow-ups, please reach out to us at creditinsights@buildamerica.com. We'll try to address them in future episodes. Thanks again for your time, everybody.